Most investors are stuck in a cycle of failure, not because they're unlucky, but because they follow the crowd. They gamble on stocks they don't understand, panic when the market dips, and miss out on opportunities right in front of them. The scariest part, they don't even realize they're making these mistakes until it's too late. In this video, you'll discover the powerful yet practical lessons Lynch used to grow billions and how you can apply them to secure your financial future. Stick with us. What you learn today could redefine your investment journey forever. One of Peter Lynch's most valuable lessons is his acknowledgement that mistakes are inevitable, even for the best investors. He famously said, "In this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. This advice encourages investors to embrace errors as part of the journey rather than viewing them as failures. The key isn't to avoid mistakes entirely. It's to learn from them and not let them derail your long-term goals. Successful investing isn't about being perfect. It's about making progress and staying committed to your strategy." Lynch emphasized that a handful of exceptional investments can outweigh a portfolio's underperformers. "You don't have to make money on every stock," he once said. "If you're right 60% of the time, you'll be ahead of the game." For example, Lynch invested in Dunkin Donuts early, recognizing its growth potential. That single winner compensated for other investments that didn't pan out. He warned against owning too many stocks, as over-diversifying can dilute your gains. Instead, focus on a manageable number of companies you truly understand. A portfolio filled with quality, well-researched stocks offers resilience and long-term success. Peter Lynch believed that successful investing starts with paying attention to what's around you. Ordinary people have a unique edge because they interact with products, services, and trends daily, insights that even professional investors may overlook. "The best stock to buy may be the one you already know about," Lynch often said, emphasizing the value of personal observation. One of Lynch's standout examples was his investment in Hanes. After noticing how much his wife loved their hosiery, he researched the company and discovered its strong financials and growing popularity. Another time, he observed the rising popularity of Dunkin Donuts, packed stores, consistent quality, and an expanding presence. These seemingly simple observations turned into highly profitable investments. You don't need a financial background to replicate this approach. What stores in your neighborhood are always busy? What products are gaining traction among your friends? For instance, consider a local coffee shop chain gaining popularity for its quality and convenience. This could be your next investment idea. As Lynch put it, "Go for a business that any idiot can run, because sooner or later one will." The companies that stand out in your everyday life often have stories worth exploring. The key is to connect what you see with a little research, turning casual observations into strategic investments. Peter Lynch's golden rule is surprisingly straightforward. Invest in what you know. While many people complicate investing by chasing trends or diving into industries they barely understand, Lynch believed that the best investment opportunities are often hiding in plain sight, within your everyday life as a consumer. Ask yourself, what products or services do you use daily? What stores are constantly crowded? If you notice a brand or product gaining popularity, it might be worth looking into. For example, Lynch famously invested in La Quinta Inns after observing its efficient operations and rising popularity among travelers. Similarly, his investment in Taco Bell stemmed from recognizing its affordable, fast, and consistent dining experience, which resonated with a growing customer base. You don't need a financial degree to spot these opportunities. Imagine noticing a new grocery chain with unbeatable prices and packed parking lots. That's a potential sign of strong customer demand. As Lynch often said, The best stock to buy is the one you already know about. Your everyday experiences give you an edge that even Wall Street professionals can't replicate. By focusing on what you know and trust, you can invest with confidence, understanding both the company and the value it brings to the market. Simplicity, paired with observation, can lead to remarkable results. Peter Lynch's practical advice: never invest in any idea you can't illustrate with a crayon, emphasizes the importance of simplicity. If you can't clearly explain how a company makes money, it's a sign you don't truly understand it. And investing without understanding is more like gambling. Think of every stock as a story. What does the company do? How does it earn its revenue? Why is it positioned to grow? If you can't answer these basic questions, you'll be left confused and panicked when the stock price drops. Will you hold on, sell, or buy more? Without clarity, you're more likely to make costly mistakes. For instance, Lynch invested in Walmart after seeing its potential to dominate the retail space. The story was simple: affordable prices, a strong supply chain, and a focus on rural markets that competitors had overlooked. When the stock faced market turbulence, Lynch didn't panic because he understood Walmart's long-term growth potential. As Lynch often reminded investors, know what you own and know why you own it. The clearer the story, the more confident you'll feel during market ups and downs. Before you buy, ask yourself, can I explain this company's business model to a friend? If the answer is no, it's time to do more research or walk away. Before we continue, take a second to like this video. It ensures more people see our work and keeps us energized to create more. Now, back to it. Peter Lynch coined the term "10-bagger" to describe stocks that increase tenfold in value. Investments with the power to completely transform your portfolio and, quite possibly, your life. But here's the catch. 10-baggers don't come with flashing lights or bold headlines. Instead, they often begin as small, overlooked companies quietly building their potential. Lynch believed 10-baggers could often be found in plain sight. These are companies you encounter in everyday life, businesses solving real problems, meeting customer needs, and growing steadily but significantly. As Lynch put it, the typical big winner in the Lynch portfolio generally takes 3 to 10 years to play out. In other words, patience is key. Take Dunkin Donuts as an example. Lynch noticed the brand's expanding popularity and consistent customer loyalty. It wasn't a flashy tech startup, it was a straightforward business with a simple model: sell coffee and donuts that people love. By spotting this early and holding on, Lynch turned his observation into a major win. The secret to finding a 10-bagger lies in combining everyday observation with solid research. If you notice a local business gaining traction or hear friends raving about a product, dig deeper. Could this be the next big thing? With patience, persistence, and a sharp eye, your next 10-bagger might be hiding in plain sight. Peter Lynch strongly advised against trying to time the market, calling it one of the biggest traps for investors. He famously said, "Far more money has been lost by investors preparing for corrections than has been lost in corrections themselves." The belief that you can perfectly predict market highs and lows often leads to missed opportunities and unnecessary losses. Even seasoned investors with decades of experience struggle to forecast short-term market movements accurately. Instead of fixating on timing the market, Lynch urged investors to focus on identifying great companies and holding on to them for the long term. He emphasized, "You can't predict the future, but you can look at the fundamentals." For example, consider the recession of 1982. Many investors panicked and sold their stocks, fearing further losses. However, those who held on to strong companies, businesses with solid earnings and competitive advantages, saw their portfolios recover and grow significantly as the market rebounded. The lesson here is simple. The stock market rewards patience and consistency, not frantic trading. Trying to jump in and out of the market based on short-term predictions is a losing game. By staying focused on the long-term picture, you'll be better positioned to ride out market fluctuations and achieve meaningful growth. Diversification is a key principle in investing, but Peter Lynch strongly cautioned against taking it too far. Owning stocks is like having children. Don't have more than you can handle, he said. While diversification helps reduce risk, spreading investments too thinly can dilute returns and make managing your portfolio unnecessarily complex. Instead, Lynch recommended focusing on a manageable number of well-researched companies that you can monitor closely, giving you greater confidence in your investment decisions. Lynch categorized stocks into 6 types to help investors diversify strategically. Slow growers like utilities offer stability but limited growth. Stalwarts, such as Coca-Cola, are reliable businesses with steady, moderate growth. Fast growers are small companies with high expansion potential, often in their early stages. Cyclicals depend heavily on economic cycles, like airlines and steel. Turnarounds are companies recovering from financial struggles, while asset plays are businesses with undervalued assets, such as real estate or patents. Understanding these categories can help investors create a balanced portfolio without losing focus. By knowing these categories and concentrating on fewer, well-understood stocks, you can achieve meaningful diversification and better returns. Peter Lynch's most vital lesson for investors is to embrace the power of patience and think long-term. The real key to making money in stocks is not to get scared out of them, he emphasized. While markets will inevitably rise and fall, strong companies with solid fundamentals tend to recover and thrive over time, making patience a critical virtue in investing. Lynch often compared investing to planting a tree. You wouldn't dig it up every week to check its growth. Instead, you'd let it take root and flourish, knowing that growth takes time. The same principle applies to your investments. Trying to time the market or reacting emotionally to short-term fluctuations often leads to mistakes. As Lynch put it, time is on your side when you own shares of superior companies. Consider a real-world example. During the dot-com crash, many investors panicked and sold their shares in tech companies like Amazon. Those who held on to their investments and weathered the storm were rewarded handsomely as Amazon grew into one of the most valuable companies in the world. Time in the market consistently beats timing the market, proving that sticking with strong companies can lead to significant rewards. So, trust your research, remain patient, and let your investments grow. During the 1980s, a decade of extraordinary stock market growth, many investors still lost money. Why? They were undone by poor strategies, emotional decision-making, and a lack of research. Peter Lynch captured this issue perfectly when he said, "People spend more time shopping for a refrigerator than researching a stock." This tendency to act impulsively rather than thoughtfully is a key reason why so many fail in the stock market. Lynch emphasized that intelligence isn't the issue. Instead, emotions like fear and greed often drive bad decisions. Investors tend to chase hot trends or jump in and out of stocks based on market noise rather than focusing on the fundamentals. For instance, someone might hear about a hot stock at a social gathering and rush to buy without understanding the business. When the stock dips, they panic and sell, locking in a loss. For example, Lynch famously invested in Dunkin Donuts because he understood its business, selling coffee and donuts to loyal customers. That simplicity gave him confidence to stay invested. The lesson? Avoid impulsive trades. Focus on understanding the companies you invest in and always prioritize research over rumors. Simplifying your approach can keep you grounded and prevent costly mistakes. Peter Lynch's strategies have proven that investing doesn't have to be reserved for Wall Street elites or financial wizards. By simply observing the world around you, focusing on what you know, and understanding the businesses behind your investments, you can confidently navigate the stock market and achieve remarkable success. Remember, the stock market isn't a gamble. It's a powerful tool for building lasting wealth when approached with curiosity, discipline, and patience. If this video inspired you, hit the subscribe button to join our community of like-minded individuals, and don't forget to like this video. It helps us continue creating valuable content for you. And before you go, check out our video on what's coming next could be even more challenging than a recession, a clear warning by Richard Wolff. So now is the time to prepare.